Okay, let's conclude our discussion of cost of capital and cost of financing for, in this case, we're going to switch gears and talk about projects. So what do we know about a project? A couple of things. All projects have different levels of risk. All companies have different levels of financing. All companies have different levels of risk in and of itself. So how do we find out the required rate of return for a project for the company? One of the ways we can attempt to do this is by what's referred to as a pure play company. That is, we want to find a company that has an identical asset base as the project that we want to create. The one challenge with this is we don't want any other industries mixed within. For instance, if we wanted to start a company that made donuts, we wouldn't want to pick a company that was a bakery that made all different kinds of baked products, or just a food processing plant where donuts were just one of the product lines. This is the challenge with this pure play concept, is we want to try to find a company that has but one type of asset, one type of product in its asset base. Now what we now know then is if we can find this company, that company has a beta that's published. That is the company's equity beta. What we want to understand though is that equity beta is based on market prices, which looks at the entire company, which includes not just the company itself and its business risk, but also the financial choices that they've made. How do they gather funds? What's the proportion of debt and equity? So the equity beta is a combination of things where I want to find out what is just the market risk of the project itself. So we have a company, right? During the 2 years that I've been working on my MBA, right? I've been thinking about starting one of these Pete's coffee companies, or a company at least looks like that. So I want to estimate my cost of capital for this company, assuming a risk-free rate of 3% and a market risk premium of 5%. Well, if you go to Google Finance, go to any of the financial places there, you will find for Pete that it has no debt, and it has an estimated beta of 0.83. So this beta represents this company's assets all by itself. It doesn't include financing. So if I want to have a company that looks just like theirs with zero debt, I'm going to need to have a required return on this project of roughly 7.15%. So how could I do this? Well, either I can start the company and hopefully make 7.15%, or I could just buy the company stock and make 7.15%. So from this perspective, I need to figure out, which is the better alternative for moving forward with the project. So if you think about the rate of return of an unlevered company, right? The expected return of all investors of their underlying assets, the weighted average cost of capital for a company with its equity and debt costs, right? Here are the costs. R sub U is this cost of financing. It's the cost of financing the company. What about its asset, the unlevered beta, right? What is the beta of this company? We need to know the beta of equity. We need to know the beta of debt. When we multiply those together in these sums, add them up, we should end up with the asset beta of the company. So your company is considering a household products division. P&G is a good example of this, right? So P&G's equity has market capitalization of 144 billion and a beta of 0.57. It has 37 billion of AA rated debt. Average yield 3.1%. So we want to estimate the cost of capital, risk-free 3%, market risk 5%. So how can we do this? R sub U, right? What is the unlevered cost of capital? Here's the debt equity, debt plus equity here. So this is the weight that goes into equity, and there's the equity cost of capital. Here is the cost of debt based on its weight. So the unlevered cost of capital is 5.29%. What should we have for beta? What should the beta be? Again, looking at the example, then we should have a beta of around 0.453%. So under the capital asset pricing model, our rate of return should be about 5.27. Again, we can utilize and calculate the rate of return based on our debt equity mix, or we can utilize beta to find the beta of the combined company and use that information. We should end up with a number pretty close. So here we have, again, this company, we have 0.57 is the beta of this unlevered company, of this levered company. They have 37 in debt, 145 in equity. So the pure play equity of 0.45 is the beta of this company, assuming it had zero debt. Now we want to take that debt and we want to apply it to our company. And for our company, again, we're going to have zero debt. Everything is in equity. So for our company, it would maintain 0.45%. So this would be just taking this company that has debt, putting it into our company that has no debt. Well, what do you think would happen if we changed the debt structure and made it different? So maybe it was our company debt was 5 or 0.5 and company equity was 1.5. So we'd have 3 times more equity than debt. Obviously, it would recalculate this and the beta for our project would change. So this project beta in the end reflects the beta of a company, assuming it had zero debt. This is just the market risk of the project itself. And then we adjust that for the equity or for the financing choices that we've made. So this asset beta, there's a video on this, but this asset beta is a rather unique way of calculating the required return on a particular kind of project that we may be interested in doing. We also need to be concerned about cash, right? Some companies have a lot of cash. Well, cash, it's risk-free, right? It reduces the average risk of more assets. I mean, the problem is it also has zero return. So since the risk of the firm's enterprise value is what we're concerned with, we need to consider debt or leverage in the terms of net debt. In other words, subtract cash from debt so we understand the entire impact of debt. That is, we could pay off some of our debt with this excess cash that's not being incorporated into our capital asset pricing model, for instance. So now we move this in and we change the value of the debt, right? Dell had 21 billion in capitalization, 8 billion in debt, and 13 billion in cash. They had more cash than debt. They could have paid that off if they wanted to, and their equity beta was 1.4. So now let's estimate what is Dell's underlying business enterprise. What is that beta? So if you take our construction here, we take its equity divided by equity plus debt, right? But now this D is net debt. So the net debt is -5. So you have 21 divided by 26. That's times the 1.41, right? That's their equity beta. Now we add that to -5 divided by 16 multiplied by the beta of debt. In this case, we'll say the estimated debt beta is 0, right? So what is the beta? So the beta of this company, not taking into account cash and debt, is 1.85. So say in this case, Dell's equity is less risky than its underlying business because of this extra cash. I think that makes sense, right? The more cash you have, the less risky you are. But it has an impact on the actual market systematic risk of your company. So what should we do about industry asset betas, right? Should we be concerned about what our competitors are doing? Maybe we can utilize this industry and the betas of the companies within that industry to, again, forecast an estimated beta for a project. So let's take this industry. Here we have the companies that are in this retail industry. Here are their ticker symbols. Here are their equity betas. Here's their debt to value, debt to equity valuation. And here are their debt ratings for the company. So let's plug some of these numbers. Let's see what we need to do. What is the average asset beta of the companies? The average asset beta is 1.16. So if you take the estimated value here, right? The value of each firm, right? Times the beta equity. So we have what? 2.38 is the equity beta for Dillard's, right? And it has a 0.59 debt to value ratio. So this is equity, percentage equity times beta, plus this is debt multiplied by the number that we got from a previous chapter on debt betas for their level of risk, for their B rating, 0.26. They have an asset beta of 1.13. If we do that for all of these companies, we can come up with an average asset beta, right? Every company is going to be different. Every industry that you can find is going to have different levels of asset betas. And you can see that for some companies, there's a great range. For some companies, it's very, very short distance, right? It's the highest and lowest asset betas within the industry are very close together. We could do this with other companies. We'll do it with, in this case, I did it with Molson Coors. Here are the equity betas. Here are the debt ratios. Here's the asset betas based on those debt equity ratios, etc. So the average asset beta is about 0.657%. So if we revise the company's equity beta, it's going to be 0.849 is the estimated or the revised equity beta of our company. Plug that into our formulas. The cost of equity for this company, 10.54%. Now we could also include the cost of debt. I didn't have that data here. I don't have that data for these companies. But if we also incorporated the cost of debt for these companies, we could then determine the weighted average cost of capital for a project that looks just like Coors. So what are the differences in project risk? Obviously, no, firm asset betas reflect market risk for the average project in a firm. Individual projects have varying levels of sensitivity, so we want to adjust them for risk. 3M, probably familiar with that company, has healthcare products, computer display products, graphic divisions, its own asset beta. 3M's asset beta represents the average risk of all of these. So Financial managers in multi-divisional firms need to evaluate products within those divisions on similar lines of business. They need to go out and find a way to find a pure play company, if they can, that reflects the risk of the individual divisions. Another factor we have to worry about is operating leverage, right? What is the amount of the company's operations that utilize capital assets? The greater the operating leverage, the greater the business risk of the company. So the higher proportion of fixed costs increases our sensitivity to the project's cash flows to market risk. So a project's beta is going to be higher in a company that uses more capital assets than it would be for a similar company in the same industry that happens to use lower operating costs or lower capital assets. So the beta itself that we're calculating doesn't necessarily cover the whole picture. It doesn't always include all the information we need to know. So what about financing? How does this ultimately affect the weighted average cost of capital? So how might the cost of capital change as a company uses leverage to finance its projects? So perfect capital markets. If we lived in that world, the choice of financing doesn't affect the cost of capital. If it doesn't affect the cost of financing, it won't affect project net present value. However, we don't live in that world. Taxes are a big imperfection. We need to incorporate taxes in the weighted average cost of capital. So the weighted average cost of capital then, the formula is transformed. We need to incorporate the cost of the after-tax cost of debt. So what should be our target leverage ratio? We want a target capital ratio that reflects the weighted average cost of capital of an unlevered company, and then we want to subtract from that this impact of taxes on the debt side of the company. Now this will hopefully become more understandable, if you will, once we get to talk about financing and how those financing choices are impacted by taxes. That could be a later topic of a video. So the R, weighted average cost of capital, how does that compare with this unlevered cost of capital? The unlevered cost of capital, that's the expected return investors expect when they hold the company's assets. In a world with taxes, it can also be used to evaluate an all-equity project that has the same risk as the company. But in a world with taxes, the weighted average cost of capital is less than the expected return on the firm's assets. Weighted average cost of capital can be used to evaluate a project that has the same risk and the same financing as the firm. So again, we need to understand how these ultimate returns can be calculated and how they can help the company. We can use this in a formula. There is a sheet called the MBA WACC. We need to incorporate the debt issues. For Coors, it was very easy because at the time of this, there were only three bonds that were issued and were still outstanding. So it was fairly easy to find the values of those, find the weights of those particular bonds, and use that to calculate the weighted average cost of capital. So that was fairly simple. Some companies might have 10, 50. Some companies could have a couple of hundred different bonds available. So this could be a rather complicated process if a company uses a lot of debt and has a lot of issues outstanding. But in the end, We can talk about the cost of equity. If we could come up with the yield for debt, right? Here's the after-tax cost of debt. So here's the market value, the common equity. Here's the weights of debt that we have. Here's the after-tax cost. So this company would have a weighted average cost of capital of around 8.05%. How do we get that? 10.54 came from the cost of equity. The average yield to maturity on this debt on a weighted average basis was about 3.51%, and their tax rate was 26. So we can determine the weighted average cost of capital for a company quite easily if we have the data. Now, I also have done a little bit of research, and I'm going to go to another website. Now, this website is called WACC.com, and I've mentioned this in a few other videos. But this weighted average cost of capital, I'm trying to put this in the square here. There you go. That's WACC. If you put in a ticker symbol, put in Coors, TAP, you can calculate the weighted average cost of capital for Coors. It tells us here that their weighted average cost of capital is about 3.13% today. So where did they get that number? Well, 2.95, let's look at the data that we had. They said that their cost of debt's 2.95. When I did this, it was 3.51. The estimated after tax rate, I had 26%. They used 29%, right? Their debt to value ratio was 51%, right? Obviously, then the equity value is the other. I had this little lopsided the wrong direction. Sorry about that. But the thing that was different for them right here is they have their retained, the cost of equity was only 4.2%, and I determined that it was 10%. So again, some big differences in numbers. This is what it shows as of and reflective of today. So maybe the answers will be different today. Who knows? But that's a way, obviously, of taking a shortcut, if you will, and trying to find the cost of capital for a company. So what are the final thoughts, right? There are a lot of assumptions that we make when we and we estimate the cost of capital. So we have to ask ourselves, how reliable are the results, right? If you think about the weights and the weights alone, right? The weights are determined by the market values of the securities. How frequently do prices of stocks change? Rapidly, every day, all day. Bonds, they're not constant, right? They don't stay the same. They do change. They're not as volatile stocks, but they do change. So if the weights are based on market values, we have to worry about how does this weighted average cost of capital number change after we've made the calculation, right? The types of approximation are no different than anyone making capital budgeting process. There are errors in estimation that they just happen, right? So errors in the cost of capital estimation are not likely to make big differences in net present value estimates as long as those errors aren't obviously too big. The capital asset pricing model is very practical and easy to use. It gives us a disciplined kind of an approach, right? We can find the numbers easily. We can calculate those numbers fairly simple. So it gives us that capital asset pricing model approach gives us a very nice, easy methodology to come up with these numbers. And in the end, it requires management to think about risk the right way. So again, this estimating cost of capital is a complicated process. There's lots of moving parts. There's lots of techniques and alternative ways to think about these costs. Um, Unfortunately, they also sometimes give us some varying differences in numbers. So um, the cost of capital, it's an important number. We need to pay close attention to how we calculate and the reliability of our answers.